Hey, good afternoon, everyone. Marty Missouri here, August 20th, 2021, with your weekly macro update. Lots and lots I'd like to share with you today, but in the interest of time, I'm going to distill it down to the usual, the inputs to our index that moved the needle this last week, and two or three that didn't, that are worth looking at. And I'm going to share a clip from one of the best interviews, Real Vision interviews I've listened to of late. I just listened to this one this morning. The whole thing is just a really good, telling, thoughtful, deep video. There's a lot of relevance in terms of what we're looking at today. However, there's a paywall. It's a subscription to Real Vision. So anybody who really likes to get deep in the weeds of macro and all things investing, Real Vision subscription really isn't that expensive. But the best I can do here is share a couple of clips that I think are very worth watching and very pertinent to our process, and help you understand why we're doing what we're doing in the face of really just a U.S. stock market that we're willing to some degree miss out on because of the way we see the longer term scheme of things and the risk reward trade-offs and where the opportunities are and so forth. So with no further ado, our index took quite the fall this last week, down about 10 points to, call it 14.58. We're still yet to cross over that area where we deem conditions now recessionary. However, this is a trajectory going in that direction. This has a lot of economists talking about growth slowdowns. Not many are talking about recessionary conditions. A few always are. We're not at this point, but we're paying very close attention to what we're seeing. You really have to now, as much as ever, if not more so, put it all into context in terms of what's inspired, this move, all that intervention and so forth, and what happens when you come off of that or begin to come off of that, or people anticipate coming off of that. Okay, so I thought I'd spend a minute on something that was a familiar chart for the last couple of years, but I haven't really gone back to it too much lately. But I think this is a good time because, as I just suggested, our number is waning in terms of the headline read of our index. When we began hedging, it was right here when our index rolled over August of 2019. And then again, folks, as I was showing you this back-tested chart of our index, now the white line is the S&P 500. These are just the scores of call it our general conditions index, placed on top of that line. Now, those of you who've been watching these for a few years will recall that back here when I first created this in 2017 and back tested it, remember, folks, me saying to you, highly likely that there's going to come a point in time where you think we've lost it or forgot how to do this, because we began to see these kinds of readings in our index. We're going to start getting conservative in our portfolio, or at a minimum hedging with options. And in all likelihood, the market's going to go screaming higher. Look at that. The early 2000s, our index rolled over, market shot higher. Late 2007, index rolled over, market shot higher. Here, index rolled over, market shot higher. Each time, though, the market did fall apart. This, by the way, folks, was the worst recession ever, even including the Great Depression. This is what, obviously, we thought would take place. But there's a new regime in town, and that's a Fed that is willing to breach the Federal Reserve Act that says you can't step into the markets other than treasuries and government-insured mortgages. Well, they did. They bought even junk bonds. And I think they'll buy stocks the next time we see something like that happen. So it took us a while, frankly, to get our heads around that. We were very excited not to catch this big decline. But, and we, of course, we were invested. We made money since then, but we didn't do this, right? Knowing what we know now, would we have been a little more aggressive, or maybe just bought a big slug of out of the money calls, bigger than we did right here? We had a really good time right off the bottom. But again, if you'd have told me this was going to be what happened, I'd say it could, but history says it won't. So we're at 15 now. We're still not red, but it does call to mind back here during the European debt crisis. I wasn't scoring an index back there, but we were doing tons of macro work. And we stayed the course because we thought this was idiosyncratic to Europe. And this was a 19% decline in stocks. This was a 10% decline This was a tough time. This was 2 years of just flatness. And of course, we caught all this because we were in equities all this time. And then even here, we go back and pull those videos and those blog posts from back then. We were very sanguine right here. This was a correction within the context of an ongoing expansion and an ongoing bull market. That narrative all changed here. And again, now I'm talking about an expansion. But this one isn't to be played the way this one was. And it's probably just a matter of time before we get some of the action that we're expecting. And I do think the Delta variant kind of delays that a little further than we otherwise expected in terms of some of the things that were heavier and really playing catch up. And there's a lot of catch up to be played. Okay, in terms of what moved the needle on our index, the first one was retail sales. We were already in neutral in terms of our scoring for brick and mortar retail sales. And this is the monthly number, this is the weekly number from Redbook, but this is online sales. So online sales has rolled over. And of course, people are out now. They're out into the malls and so on and so forth. So that makes some sense. So that went from positive to neutral and lost a point. Consumer confidence, I brought it back up to neutral from negative. Part of it is the Bloomberg, it changed the name to the research firm, I think it's Langford, that actually they get the data from, but it's always been the Bloomberg Comfort Index. And really strong. I mean, the consumers in that survey are feeling pretty good about their prospects. The conference boards just, was fairly flat, ticked up a little bit. It was the University of Michigan's that really rolled over, and we're paying very close attention to that. And as I mentioned, the Delta variant and largely fears over inflation going forward really had a lot to do with that. One thing I should point out is the sample size in the University of Michigan survey is substantially less than these other ones. Home builder confidence was not a plus. It's rolled over now for, I think, the third straight month. Current conditions are really waning. I mentioned this on the written blog this week. However, they still are pretty optimistic, 6 months out. This one did not move the needle, but it's worth showing because it's been good to us over the years. And this is the leading economic indicator, coincident economic indicator ratio, right? So when the leading indicator is outperforming the coincident indicator, that says good things about the prospects for the economy going forward. And that just continues to tick up. That came out this week. When it rolls over, that tells you, that you should start thinking about recession. Of course, it's not the only thing we look at. But in the 80s, it was definitive. In the 90s, you had, you rolled over, you came back out of that, and then you rolled over for good here in 1998. And remember, folks, in our index, you can see that's when we started rolling over in our macro index. And then actually it began waning here in 2005, 2006. Doesn't mean clearly that a recession is imminent. But, it says, within the next couple of years, be on the lookout. As you all know, we are very bullish on commodities given our long-term inflation thesis. And but also recall in here, a lot of my commentary, this was unsustainable. This is not a sustainable trajectory. We kept getting these technical flags that were bullish, and sooner or later that was going to fail, and it did in here. I remember right around in here I was saying the only thing I don't like about this position is that everybody likes it. It doesn't feel good to be on the side of the boat everybody's on. Well, I can tell you that's reversed. Technically speaking, this was negative going into it, right? We had a higher high, and then we had momentum breaking down. It's getting close to being oversold. I'm not looking for a big bad bear market in commodities. Having said that, we are hedging our ag exposure. We are hedging much of our energy exposure. And now we are hedging emerging markets where there is a lot of commodities exposure there as well. So we have beefed up the downside protection. And as I said in yesterday's blog, folks, that doesn't really help us, on these single digit drawdowns. Depending on the day, it was interesting. Wednesday, the S&P was down over 1%. Our core portfolio was down less than 0.5%. And that's because we just have a lot of non-correlated stuff. And then yesterday, everything fell apart in the morning. The market came back. We didn't. We were down when the market was flat. And then today, the market's come bouncing back, and we're just kind of bouncing along the flat line because we own more of the cyclical stuff and less of the expensive, growthy, frothy tech stuff that is so historically over-owned, which makes it very dangerous. at this juncture. And I was flagging this last week as a positive, and actually it moved the needle a little bit on our index. And this is the sector to S&P 500 weightings, where we have these key sectors. Above 100 means they're outperforming the S&P. Below 100 means they're underperforming. This is a 30-day look. Well, last week, for the prior month, we had most of the real economically sensitive sectors above 100, outperform the S&P, when all three of these defensive sectors were below 100, underperforming. What a difference a week can make. Tech is going to do well when people are afraid of the economy, thinking about lockdowns, and interest rates are dropping, right? Financials have held up pretty well here, but you notice they've been dropping, though. They've been moving. This keeps up, and interest rates stay down, and financials will drop below 100. But consumer discretionary, materials are still holding up there, but they're falling, right? Energy plunged below on a relative basis. It actually did plunge, but relative to the S&P 500. Industrials, below 100. But staples, 101. Utilities, 106. Healthcare, 104. So suddenly, just literally in the course of a week, complete upside down turn. Okay, so that's all on our macro index. Now I want to set the stage for the video clip I'm going to show you here. It was yesterday, I believe, that I showed this chart, or maybe the day before, from the bottom of the real estate mortgage bubble pop, worst recession since the Great Depression. Asia Pacific stocks versus US stocks. In my article, I painted correlation between the dollar, a negative correlation, and international stocks in particular. But I wanted to point out that if you're looking for value, if you're looking for stocks that really haven't gone through remarkable, virtually unbelievable historic extremes, you can find them in the Asia Pacific region. As I've shown you time and time again, there seems to be these roughly decade-long periods of US outperforming, underperforming, outperforming, and so forth. Right now it says we're early, but hard to lose faith when you just look at simple setups just like that. And of course, there's a lot deeper thought and data behind it. But what I want to do right now, though, is I want to fold in another one of our top positions, and that is the Eurozone, right? So here's Europe, and basically it's the same story, only worse from a relative return standpoint. I mean, Europe has done absolutely nothing. So I want to show you a video clip of an interview with an exceedingly sharp analyst. Her name is Annika Trajan. And I'm going to show you the clip where she's asked the question, what do you like now, right? And what are you concerned about?
Look, I mean, I mentioned Europe earlier. Europe does stand out. And the reason Europe stands out is, I think it's so easy to forget Europe was on the verge of a recession pre-COVID, right? Europe has had, like most geographies, of course, Europe has had but even more so in Europe has had a major issue because besides the usual sort of cyclicality, GDP, etc., Europe also had its euro crisis, right? And then Europe has generally suffered from this massive fragmentation problem versus other regions, which means, from a fiscal policy perspective, it was always handicapped versus some of the others. There was too much differences amongst the member states to reach consensus. So by definition, you never get that big wow factor that you can get in other nations, apart from COVID recovery fund, right? But even on the COVID recovery fund, how bizarre if you think about it. Again, let's zoom out. How remarkable that this 750 billion of recovery fund for Europe has only just started in terms of being spent into the economy, right? So all of that COVID wow factor that other regions have enjoyed significantly, we're only just starting in Europe. That's very interesting. The other thing about Europe is Europe has been totally neglected, right? Again, people tend to repeat what they see, right? It's the general human psychology. European equities has not made investors money over the last 10 years. In fact, it's been appalling, right? And obviously a big factor of that is the dearth of technology. It's a very old economy equities market, but it also becomes a bit self-fulfilling. So what's interesting is you start off with a lower allocation level. So for capital allocators to put more funds into Europe is actually less difficult than for other regions. So you've got more of that incremental effect. You enjoy the fact that you're finally entering, it's certainly not a fiscal union, but at least we're getting a little bit closer to that. Expectations, to your point about analyst expectations for European equities are certainly lower than they are for the US, which is interesting. Add to that, you've got, you've got much more of the idiosyncrasy that I was mentioning earlier in Europe, because it's much more stock specific, it's much more regional specific. So I think you definitely have some sort of powerful pockets over there to sort of put the glasses on, get a little bit geeky, and sort of investigate where opportunities lie.
Okay, so that's what you're constructive on. And what do you think is the most overrated or maybe overvalued part of the global equity market? Where is it? What sector is it in? Same question, but the opposite.
Yeah. So I think there, following also the point that you've made about, big, large cap growth. Large cap growth is completely overweighted, right? It's been far too consensual. Any pattern that's been on for the last 10 years, which is what's happened, is by definition going to be too consensual, right? Which means there's by definition froth in there. Now the next point is, well, does that mean the entire growth space has been overrated, etc.? No. But there is certainly a big chunk of names that have sort of enjoyed this concept of a rising tide lifts all boats, right? So to your point, companies trading at 20 times, 30 times revenues is not normal, right? It's only justified if there's something spectacular going on behind it. It's only justified if companies are truly enjoying the network effect advantage that we're all obsessed with right now. But there needs to be proof. There needs to be tangible proof. For example, if you're sort of dissecting these businesses in terms of cohort behavior, for every new customer that is part of this sort of network effect platform, does the platform get incrementally better, yes or no, and prove it, show it in data, show it in margins, show it in stickiness. And I think, that whole sphere, that whole world has definitely got some large frothiness about it.
And then the next quick clip has to do with where the European Central Bank fits into that bullish narrative.
But the difference between, I think, the ECB and the Fed, and that answers your question about level of European inflation, Europe still acknowledges the fact, they say inflation is transient, but European inflation is not seeing exuberance, right? So we're seeing very much sort of the 4 percentage points level. And the ECB, Lagarde, is still talking about acting forceful if needed. And that's forceful in a certain direction, of course. It's forceful in a direction of support in order to keep the economy going, keep things growing. Whereas Powell was talking more, he wasn't talking about being forceful to keep things going. It was more that, hey, don't worry, we will tolerate things being slightly exuberant if they need to be, because we don't want to get it wrong this time.
So in a nutshell, Europe, and I would argue like Asia, has really been stuck in the mud for an extended period of time. The US, on a relative return basis, we think is probably very close to running its course. And so despite the concerns and the reasons that we're hedging our portfolios right now, we're actually pretty excited about the opportunities in some areas that they really haven't existed now for well over a decade. So we think the thing to do going forward is to approach the world from a macro perspective, not chasing Facebook and Apple anymore. Not that we shouldn't own a little bit of that, and we do in XLK, which is our tech ETF, but that very likely is not going to be where the good, strong, fundamental growth is going to be found in portfolios over the next, I'd say, decade or so. I'll leave it there. Thank you, as always, for watching and listening, and much more to come. Have a great weekend. Bye-bye.